A bubble can begin with four dangerous words. Everyone else is buying. When millions of investors follow the same story, individual bias can become market momentum, crowded portfolios, and violent reversals. In this lecture, we trace how psychology moves prices and how disciplined allocation, rebalancing, governance, and ethics can keep investors from losing perspective when the crowd takes control. We will study behavioral finance and investment decisions. Finance often begins with elegant models, valuation models, portfolio models, risk-return trade-offs, and market efficiency. These models are powerful, and we need them. But in real markets, decisions aren't made by formulas alone. They are made by investors, advisors, analysts, managers, traders, and committees. Behavioral finance begins with a practical observation. People make financial decisions under uncertainty, incomplete information, time pressure, career concerns, social pressure, and emotional stress. That doesn't mean investors are always irrational. It means the decision environment can push even intelligent people toward predictable mistakes. In this lecture, we will connect three levels of behavior. First, individual behavior, how a person evaluates information, risk, gains, losses, and uncertainty. Second, group behavior, how investors, analysts, institutions, advisors, and committees influence one another. Third, market behavior, how sentiment, capital flows, liquidity, and limits to arbitrage can affect asset prices. The key message is simple. A technically correct model can still be used poorly if the decision process around the model is biased. A portfolio can look diversified on paper, but fail in practice if the investor abandons it during stress. Behavioral finance helps us understand these risks and design better investment processes. Let's begin with the connection between individual bias and market price. A behavioral bias matters for markets only when it changes action. A private opinion that doesn't affect trading, risk-taking, advice, or governance may have little market effect. But when a bias changes demand for securities, portfolio weights, leverage, valuation assumptions, or willingness to take risk, it can become economically important. The idea is that the observed market price can be thought of as having a fundamental component and a non-fundamental component. We should be careful. Fundamental value isn't directly observable. It must be estimated. Traditional valuation focuses on expected future cash flows and the discount rate applied to those cash flows. Behavioral forces can enter both sides of that process. Investors may extrapolate recent growth too far into the future. They may use required returns that are too low during optimism or too high during fear. They may overweight vivid stories and underweight base rates. Now, why don't rational investors immediately correct these mistakes? Because arbitrage is limited. Short sale constraints, transaction costs, financing risk, benchmark risk, career risk, and model uncertainty can all prevent mispricing from disappearing quickly. So behavioral finance doesn't say markets are easy to beat. It says market prices can be affected by human behavior, and exploiting that behavior requires discipline, patience, liquidity, and risk control. Now let's discuss market efficiency and herding. Market efficiency means that prices reflect information. Weak form efficiency focuses on information in past prices and returns. Semi-strong form efficiency focuses on publicly available information. Strong form efficiency includes private information as well. Behavioral finance doesn't reject market efficiency completely. A market can include biased investors and still be difficult to outperform after costs. Competition, professional research, technology, and arbitrage can reduce many opportunities. The interesting question isn't whether markets are perfectly efficient or completely inefficient. The real question is where behavior may create pressure, how long that pressure can last, and whether it can be exploited after costs and risks. One important behavioral force is herding. Herding occurs when investors make decisions partly because other investors are making similar decisions. Sometimes this is explicit, as when investors copy trades. Sometimes it is implicit, as when many investors respond to the same benchmark, narrative, or incentive. Herding isn't always irrational. Observing other investors may provide information. The danger appears when investors place too much weight on what others are doing and too little weight on independent analysis. Herding can occur through information cascades, reputational concerns, benchmark pressure, popular narratives, and flow-driven buying or selling. When many investors hold similar positions for similar reasons, markets become fragile. If the shared belief changes, prices can adjust sharply. Investor sentiment is another major behavioral force. Investor sentiment refers to broad optimism or pessimism that affects demand beyond what fundamentals alone can justify. Sentiment can influence risk appetite, valuation multiples, issuance activity, trading volume, and expected returns. Sentiment is difficult to observe directly, so analysts often use proxies. These may include investor surveys, fund flows, closed-end fund discounts, issuance activity, option-implied measures, credit spreads, trading volume, and media tone. But each proxy is imperfect. A disciplined analyst should never treat one measure as a complete picture of market psychology. Sentiment tends to matter most for assets that are hard to value and hard to arbitrage. When future cash flows are uncertain, when operating history is limited, or when value depends heavily on expectations far into the future, small changes in belief can have large effects on price. It is also important to separate sentiment from information. Prices should rise when genuine information improves expected cash flows or reduces risk. The behavioral issue is whether the price response becomes excessive relative to the information. In practice, information and sentiment often appear together. A new technology can be economically important and still become overpriced. A risky company can be genuinely weak and still become oversold. Behavioral analysis requires judgment, not automatic contrarianism. Now, let's turn to market anomalies. A market anomaly is a return pattern that appears inconsistent with a particular asset pricing model. Common examples include momentum, reversal, value effects, post-earnings announcement drift, size effects, and calendar effects. But we must be careful with the word anomaly. An apparent anomaly may reflect behavioral mispricing, but it may also reflect omitted risk, data mining, transaction costs, taxes, short sale constraints, or changes in market structure. This is where the joint hypothesis problem becomes important. A test of market efficiency is also a test of the model used to estimate expected returns. If a security appears to earn abnormal performance relative to a model, that result may mean the security was mispriced, or it may mean the model left out an important source of risk. Behavioral explanations for anomalies often rely on recurring ideas. Underreaction occurs when investors update beliefs too slowly after new information. Overreaction occurs when investors place too much weight on recent news or extreme past performance. Attention limits cause investors to react more strongly to information that is vivid, easy to understand, or widely covered. Representativeness leads investors to infer a long-term pattern from limited evidence. Anchoring causes investors to adjust too slowly away from prior beliefs. The disciplined question isn't simply, does a pattern exist? The better question is, does the pattern have an economic explanation? Does it survive real-world implementation costs? And is the risk acceptable? Let's discuss bubbles, crashes, and collective investor behavior. A bubble is a market episode in which prices appear to rise above levels justified by reasonable expectations about cash flows, risk, and discount rates. The word appear is important because fundamental value isn't directly observable. It is often much easier to identify a bubble after the fact than in real time. A rapid price increase isn't automatically a bubble. Prices can rise because cash flows improve, risk declines, interest rates change, or technology creates real value. A behavioral bubble is more likely when rising prices are accompanied by extrapolative expectations, heavy public attention, excessive leverage, relaxed financing conditions, extreme valuation narratives, and the belief that traditional valuation no longer matters. A crash is a sharp decline in prices, often connected to sudden changes in beliefs, forced selling, margin pressure, liquidity shortages, or a rapid increase in perceived risk. Collective behavior affects asset prices through demand, supply, risk-bearing, and liquidity. If many investors want the same exposure at the same time, prices may rise even without a comparable change in fundamentals. If many investors want to exit at the same time, prices may fall even when long-run fundamentals remain stable. For managers, the question isn't simply whether the crowd is emotional. The question is how crowd behavior changes the opportunity set and the risk of implementing a strategy. A contrarian position can be analytically correct and still fail if the portfolio cannot survive the path to convergence. Behavioral finance is especially important in portfolio management. The goal isn't to eliminate emotion. That is unrealistic. The goal is to design a process that prevents emotion, social pressure, and cognitive shortcuts from dominating investment decisions. Traditional portfolio theory asks how to choose weights that balance expected return and risk. Behavioral finance asks how investors actually estimate expected return, perceive risk, and behave when realized returns differ from expectations. An investor may appear comfortable with risk in calm markets, but become highly loss-averse during a drawdown. A committee may approve a long-term allocation, but abandon it after peer underperformance. A manager may become overconfident after a period of strong results. This is why the most important portfolio document is often not the spreadsheet. It is the investment policy statement, governance policy, or written decision framework that explains how the spreadsheet will be used. Practical guardrails matter. Capital market assumptions should be documented before allocation decisions are made. Allocations should be stress tested. Concentration should be limited across asset classes, managers, themes, and securities. Rebalancing should follow pre-specified rules rather than headlines. Strategic allocation should be separated from short-term tactical views. Deviations from policy should require written justification. A good portfolio process turns long-term objectives into rules that can survive short-term emotion. Now let's focus on asset allocation, security selection, and rebalancing. Asset allocation determines the broad mix of exposures in the portfolio. Because it drives much of portfolio risk, behavioral mistakes at this level can dominate security-level decisions. Common asset allocation biases include recency bias, loss aversion, overconfidence, status quo bias, home bias, mental accounting, and availability bias. The disciplined investor must distinguish between a change in circumstances and a change in mood. A change in liabilities, taxes, liquidity needs, time horizon, or risk capacity may justify a new allocation. Fear after a market decline by itself isn't an investment thesis. Security selection brings its own biases. Investors may prefer familiar companies, seek confirming evidence, anchor on prior prices, fall in love with compelling stories, overreact to salient headlines, underestimate uncertainty, hold losers too long, or value current holdings more simply because they already own them. A central principle is this: a good company isn't automatically a good investment. Price matters. Expected return depends on the relationship between future fundamentals and current valuation. Rebalancing is both a risk management tool and a behavioral tool. It returns portfolio weights toward policy targets after market movements or cash flows create drift. Rebalancing can be done by schedule, by threshold, by a hybrid process, or through cash flows. Its behavioral value is that it turns a difficult emotional decision into a pre-committed process. Performance evaluation is another area where behavior matters. Performance evaluation asks whether results were good, bad, skillful, risky, or lucky. The challenge is that outcomes are visible, while decision quality is harder to observe. A common mistake is outcome bias, judging the quality of a decision only by the result. A good decision can produce a bad outcome because uncertainty is real. A bad decision can produce a good outcome because luck is real. Evaluation should separate process, risk, benchmark, and outcome. Active return and risk-adjusted performance measures are useful, but these measures are incomplete if we ignore benchmark fit, factor exposure, leverage, liquidity, fees, taxes, trading costs, and sample length. Behavioral biases in performance evaluation include hindsight bias, self-attribution bias, benchmark selection bias, survivorship bias, short horizon bias, and narrative fallacy. After results are known, it is tempting to create a confident story. A disciplined evaluator asks what was known before the outcome occurred. Good process evaluation asks whether the benchmark was appropriate in advance, whether risks were identified, whether the manager followed the stated process, whether performance came from intended exposures, and whether the time horizon was long enough. Tools such as investment memos, checklists, decision journals, and pre-mortems create a record before outcomes are known. That record reduces the temptation to rewrite history. Finally, let's connect behavioral finance to advisors, investment committees, and ethics. Advisors and committees can reduce behavioral mistakes when they improve discipline, documentation, independence, and accountability. But they can also amplify mistakes if they become overly focused on peer comparison, short-term results, hierarchy, or political pressure. A good advisor helps clients distinguish between risk tolerance in calm markets and risk tolerance during stress. The advisor helps convert goals into policy, explains trade-offs, discourages panic selling, prevents performance chasing, and sets realistic expectations before volatility arrives. A good investment committee provides governance rather than constant trading signals. Its role is to approve policy, monitor implementation, evaluate performance, manage conflicts, and ensure that decisions remain consistent with objectives and constraints. Productive disagreement is valuable. The purpose of committee design isn't to eliminate disagreement, but to prevent disagreement from being suppressed by groupthink, hierarchy, sales pressure, or fear of being different. Behavioral finance also has an ethical dimension. Biased decisions can harm clients, beneficiaries, shareholders, and stakeholders. Ethical practice requires suitable recommendations, fair presentation of performance, consistent benchmarks, honest communication about uncertainty, documentation, and conflict management. So the big lesson is this. Behavioral finance connects market efficiency, portfolio management, and investment ethics. It teaches us that better investing isn't only about better models, it's also about better decisions. Thank you for watching. I hope this lecture helped you learn and think more clearly about behavioral finance.